Good afternoon. Welcome to the 2025 Capstone Conference hosted by UC San Diego, Ready School of Management, and the Master of Professional Accounting program. I'm Professor Menes Itingekum, joined by my colleague, Jim Dioid, Executive Director of the MPAc program. We're also joined by our exceptional TAs, Stacy Kang and Sieda Ula, whose leadership and support have been instrumental throughout this Capstone experience. Over the next 2 days, you will hear boardroom-ready insights from a remarkable group of graduate students, the product of rigorous research and focused preparation. This year team, investing in the future, building resilient and sustainable growth, highlighting how board navigates strategy, oversight, and innovation in an increasingly complex world. Student panels will tackle AI in M&A, ESG assurance, blockchain governance, audit ethics, and more, grounded in SEC and PCOB guidance with real-world takeaways for boardroom and leadership teams. We're very grateful for our supporters, including Apple, PwC, Deloitte, EY, KPMG, Moss Adams, RSM, BDO, whose partnership helped power this program and inspire the next generation of leaders and professionals. Now close your tabs, put on your best headphones, and join us in celebrating learning, leadership, and the future of the profession. Welcome to the 2025 Capstone Conference. Let's begin. Today's session is going to be focused on digital banking, regulation, and the future of financial services. If we look at some of the recent news in the marketplace, the Wall Street Journal recently reported rising tension between DeFi innovation and outdated regulatory frameworks, warning that financial modernization is outpacing institutional oversight. The PCOB and SEC are signaling tighter scrutiny of digital asset controls and AI-enhanced operation. Today's panel focuses on how digital transformation, namely blockchain, AI, and decentralized finance, is reshaping the compliance, audit, and fiduciary landscape in financial services. It also addresses how boards must modernize risk frameworks, understand regulatory expectation, and future-proof governance structures while enabling innovation. I'm delighted to welcome Dylan Crawford to our virtual stage at the Ready School of Management. Dylan and his colleague will now lead a session. Dylan, the stage is yours.
Thank you, Menace. Welcome, everyone. My name is Dylan Crawford. Our team is really excited to share with you our presentation on digital banking and financial services. It is my pleasure to pass it to my colleague Samuel, who will be facilitating today's conversation.
Thanks, Dylan. Hi, everyone. Thank you for taking the time to join us today, where we'll be speaking about digital banking regulations and the future of financial services. This is our agenda for today. I'll give you guys a few seconds to go over it. And this is our panel for today. That was Dylan, and right now, speaking is Samuel Mehta. So let's get into it. What is digital banking? Per JP Morgan Chase, it is an advanced solution that uses technology to provide a complete set of banking services. And what type of services are these? Well, typically any service that a traditional bank will offer, but they're available 24/7 on a mobile or desktop platform. Now, within the past 15 years, most traditional banks have gone digital, and I'm going to give a quick overview as to why. So some traditional banking pros are, well, the main one is the ability to transact with cash, the ability to withdraw and deposit physical cash into your account. Another one of the advantages is the in-person support. Some people prefer the face-to-face interactions when dealing with people at the bank. But in order to do that, we get to the disadvantages. You have to take time out of your day to drive to the bank. And once you're in the bank, you might have to wait for some long lines if you go at a busy time, which could be very inconvenient. Now, what is convenient? Digital banking. Imagine being able to do whatever you want with the click of a button. That's what these apps offer. And some disadvantages to that are the limited support. So instead of having the in-person support, you might have to deal with an automated teller or wait on the line for 30 minutes to hear from a representative, which could be annoying. Some other limitations include glitching or just technical difficulties. Now, a quick overview of digital banking. So in the 1960s, Bank of America introduced the first ATM, allowing customers to withdraw cash from their account without a bank teller. Now, this might seem like a relic, but at the time, it was a very innovative solution. Then in 1996, Wells Fargo became the first bank to provide online banking services through a website. And in 2007, the iPhone was released. Now, this was extremely revolutionary because most traditional banks soon after developed a mobile banking app. And after a few updates, we get to what we have today, which are pretty good apps. Then in 2008, Bitcoin was released as a decentralized currency running on blockchain technology. This was the beginning of cryptocurrency, and it's a topic that Dylan will touch on later. Fast forward 17 years. I'm not going to go into the details because I assume we've all lived through these technological developments, but that's where we are today. And I'm going to give some examples of financial tools in the digital age. Now, the main reason I want to do this is to express the fact that financial services no longer apply just to traditional banking institutions. Today, regular companies are building financial service infrastructures to support and increase their operations. They're not just banks anymore, they're products. So let's begin with buy now, pay later. Per Statista, in 2019, BNPL loans totaled $34 billion, and in 2024, they were $386 billion. However, BNPL has its limitations. Between 2021 and 2022, 45% of BNPL originations were made by deep subprime borrowers, categorized as those having FICO scores between 300 and 579. Now, just out of pure curiosity, I got this from the Chase website. If you try to get a credit card with a score of 500 or less, it says, quote unquote, you may want to consider improving your score to improve your chances of getting a card. So, as you can see, these are really high risk transactions. And one way that companies like Afterpay, Klarna, and Affirm are mitigating this risk is that instead of like with credit cards where consumers have to pay off the balance themselves, these companies are taking money directly out of their customers' accounts on a monthly basis. So talk about innovation. Then we get to peer-to-peer payment systems. Examples of these are PayPal, Venmo, and Zelle. Per Forbes, P2P transactions total $1.4 trillion in 2023. And these companies are doing it in different ways. Their main goal is offering quick and reliable ways to send money between people or businesses. For example, one way that I use Venmo is when I go out to dinner with some friends, someone will pick up the tab and then we'll all just Venmo each other and we all leave happily ever after. It's very convenient. However, they are subject to risks of fraud and accidental transfers, meaning if you send money to the wrong account, the wrong person, and you don't know that person, you might not get that money back. So there's definitely some risks there. Now, the third example that I want to give are digital wallets. Some example of these are Apple Pay, Google Pay, and Samsung Pay. As you can see, they are very creative with the names. Digital wallets allow you to store your payment information on your phone. And instead of tapping your credit card, you tap your phone when you're buying something. So it's pretty convenient. In 2023, the total value of digital wallet transactions was $9 trillion, and it is expected to reach $16 trillion globally by 2028. And if we take a look at the graph here, it shows that digital wallets are now the most common form of payment compared to credit cards, debit cards, and cash. And that's only projected to increase. So keep your eye on these tools. Now that we've gotten a proper understanding of the digital banking ecosystem and how it's evolving, I'm going to pass it to Dylan, where he'll be talking about traditional banks and how they are adapting today.
Thank you, Samuel. Like you mentioned, financial services are changing, and quickly. Today, I'll be talking about how this changing environment has resulted in traditional banks and others adapting new technology and establishing new partnerships as they look to stay ahead. Today, probably the most important technology being implemented is blockchain. Blockchain is a decentralized digital ledger that records transactions across a network of computers. This ensures transparency and eliminates the need for a central authority, like a traditional bank. Once a transaction is recorded in a block and added to the chain, it's virtually impossible to alter, making it highly secure and tamper-resistant. Here is a visual representation comparing the traditional approach to the blockchain approach. This technology underpins cryptocurrencies like Bitcoin and is now being adopted by banks for secure and efficient operations. Let's see how banks are leveraging it. Banks are harnessing blockchain networks to streamline operations. For example, blockchain networks like JP Morgan's ConnectCs allow banks to share payment-related information securely and quickly 24/7. Using these blockchain networks, another innovation being used are stablecoins like JPM coin. They are, in a way, tokenized dollars that operate on the blockchain and are pegged to the value of traditional currencies, most commonly the US dollar. Combining the reliability of the dollar and the speed of blockchain, stablecoins enable instant settlements of large institutional payments instantly. They're also much faster and cheaper than traditional transaction methods. This has led to a large demand for stablecoin transactions. Looking at the graph on the right, you can see this demand growth quickly from 2020 to 2025, with stablecoins already surpassing Visa and slowly enclosing on traditional transaction methods in automated clearinghouses. Now, why is this important? Well, it shows a clear demand for the product, and traditional banks need to adapt from automated clearinghouse transactions to these new forms of transactions if they want to stay ahead. Blockchain is clearly driving efficiency, but it's also not the only technology banks are adopting. Artificial intelligence is another game changer. Improving speed and security in the lending process, companies are now using natural language models like, in JP Morgan's case, Colon, which extracts key terms from thousands of commercial agreements, saving time and reducing errors. They're also introducing automated loan underwriting. These use machine learning to assess borrower creditworthiness beyond traditional credit scores. Companies now recommend personalized loan offers using AI-based behavioral modeling using their consumer data. On the back end, real-time transaction monitoring is also critical. AI models analyze transactional behavior to flag anomalies like irregular transfers or suspicious logins, enhancing security. These AI-driven tools are making banking faster, smarter, and more secure, but they also require robust oversight to manage risks. To keep up with digital banking's rapid evolution, like Sammy talked about, traditional banks are forming strategic partnerships, creating a more interconnected financial ecosystem. For instance, JP Morgan recently launched a $10 billion private credit partnership with firms like Cliffwater and FS Investments to expand their offerings. They're also partnered with crypto exchanges like Coinbase and Gemini in the past, providing their deposit and withdrawal services for US users. These partnerships show a change from siloed banking to collaboration with fintechs, private credit firms, and non-traditional players. In other words, it reflects a shift from a very centralized to a more dynamic, interconnected ecosystem. By working together, banks can meet consumer demands and stay competitive in this dynamic landscape. You now have an understanding of how financial services are changing. Firms are leveraging new tech like AI and blockchain, as well as collaborating more to meet demand. However, like some of my colleagues will talk about, these changes don't come without risks and new compliance concerns.
Great. Thanks, Dylan. As you can see, emerging technologies like AI and blockchain are coming, and they're coming in fast. Therefore, companies must be strategic with their implementation. And I'm going to pass it to Judy and Ning to help develop an understanding of compliance requirements and regulations pertaining to these technologies within the digital banking world.
I'm Judy. Now I will talk about the regulation and compliance. As the financial institution embrace digital transformation, regulators are now working to keep pace. Let's begin with PCAOB. PCAOB standards are now no longer just about the financial accuracy. They ensure that technology governance and the digital system oversight are firmly integrated into the audit process. PCAOB standards requires auditors to assess the effectiveness of IT system and integrate the technology risk into the audit planning. For example, AS 2605 now requires auditors to evaluate whether AI and automation tool have the proper governance and the control in place to prevent overrides and maintain the reliability, especially since this tool can bypass the traditional check and balance. Next, let's turn into the SEC. Regulation SK and Form 8K require digital bank to disclose the technology risk and also report the major cybersecurity incidents promptly. This improves the transparency and the investors' awareness. Moreover, here's an example how the regulations are being modified with the social needs and the development. For the crypto assets, SAB 121, which initially required the digital bank to record the safeguarded crypto assets along with the matching liability in their statement, has been repealed. It has been replaced by SAB 122, which now requires them to assess the risk of loss for the safeguarded crypto asset by using the standard accounting rules, which means that a liability is recognized only when the loss is probable and can be reasonably estimated. Its update eases the reporting burden while still emphasizing the risk evaluation for the crypto asset. As the digital innovation reshaped how the financial reporting is done, SOC holds the management accountable not just for the number, but also for the system behind them. Section 404 requires management to establish and certify internal control over the financial reporting. Now they are required to ensure the technology are auditable and also the output are verifiable. For the Section 802, which mandates data must be tamper-proof and securely stored, is to prohibit the unauthorized change or deletion for the data. And furthermore, as we discuss more about the digital banking expand, so does the risk exposure. Many consumers today store value in the app that are not traditional bank, such as Venmo, PayPal, and other platforms. Since in the event that a platform collapse or the bankruptcy, consumer may find that their assets are neither insecure nor recoverable. So how the regulation evolved to protect the consumer when the value can disappear overnight? Popular apps such as Venmo and PayPal were not fully regulated as bank before, but now CFPB requires them to follow the consumer protection laws, which aligning them more closely with the traditional banking standards in the areas such as data privacy and fraud prevention. Moreover, in the past, if the funds stored in this app are not moved or swapped into the partner bank, consumer could lose all their money. In order to protect consumer, some platforms are now partnership with the FDIC Insecure Bank. However, here's the catch. The protection only applies if the funds are actually transferred into the partner bank already. This nuance is often unclear to users. Moreover, many of crypto payments and stablecoin tools are lack of clear regulation, which do not offer the guarantee for the redeeming value. To close the gap, the CFPB has proposed applying the Electronic Fund Transfer Act to the both digital wallet and stablecoins. And then, as we continue exploring protection in the digital banking, here's one area underpinning nearly every transaction, app, and platform, that is data privacy. Consumers are now sharing more information than ever before, so how the data is protected and how companies can use this without crossing the line. In the US, the GLBA follows the opt-out model, which allowing the institution to share the consumer data with third party by default, unless the consumer actively opt out. It's put the burden on the consumers and the users to protect their own privacy. However, in the contract, CCPA and the GDPR use the opt-in model, which require company to obtain the clear and informed agreement before the collecting and sharing the data. This laws give the consumer greater control and emphasize the transparency and the user right. For instance, a bank wants to share your account balance and the transaction history with the third-party marketing firm to send you a personalized credit card offer. Under the GLBA, the bank can share this information by default, since if you do nothing, your data can be used by the marketing. Under the CCPA or GDPR, the bank is not able to proceed unless they get the approval from you first. If you choose to opt in before they collect and share the personal data, such as email and purchase history, they can share the data with the marketing purpose. Now I will pass to our colleague Ning to discuss what could be the possible modification on the regulation to protect consumers.
Hi, this is Yiming Xue. Thanks for Judy's explanation of current regulations and the gaps we still face in protecting digital finance users. Now, I'd like to shift our focus to the future. What can be done to improve protections? Let's begin with the consumer side. As we've just seen, peer-to-peer apps like PayPal and Apple Wallet may not be fully bank regulated. If funds don't flow into an account that's FDIC insured, users may have no protection if the platform fails. So future regulations should first require FDIC-style disclosures so users could know if their funds are protected or not. Second, apply the Electronic Fund Transfer Act. This would guarantee basic consumer rights like refunds and fraud protection across all digital wallets. And also, as more platforms collect sensitive data, we also need to strengthen oversight of data use. Another important thing is how companies store crypto assets. While my peer Dylan showed how banks are developing with blockchain-based solutions like JP Morgan Coin, we must also ask, are consumer protection evolving fast enough to match this innovation? Some companies use a single wallet to store both their funds and customer assets, but that may create confusion and legal risk, especially in bankruptcy. That's why future regulations should require wallet-level asset segregation. Customer assets should be held in separate wallets to make ownership clear and reduce loss during company failure. Now let's turn to blockchain applications. Current systems of blockchain like stablecoins and DeFi sometimes may raise a risk. Let's start with algorithmic stablecoins. The collapse of Terra's USD example showed how quickly public confidence can fade, then cause systemic financial instability. While some rules exist, like in New York, but the US still lacks a federal framework for algorithmic stablecoins. So future regulations should create clear licensing rules, require audited reserves, capital standards, and redeemability policies. Also clarify what happens when a stablecoin fails, especially for retail users. Now let's look at DeFi platforms. These systems are often anonymous, with no legal entity, no licensing, and no accountability. So what we need to do are clarify accountability, enforce KYC and AMLC compliance, and extend basic consumer protection to DeFi users. Finally, let's talk about AI in financial decision-making. AI helps banks scale faster, but it often operates like a black box, where users don't know how decisions are made or if they are fair. I think a good example is the Apple credit card case. Its AI-based approval system reportedly gave lower credit limits to women compared to men with similar financial situations. That caused public backlash and regulator investigation. To prevent such bias and build trust, future regulators should require explainable AI standards. This means requiring companies to disclose how decisions are made, including the data and the logic used, and also conducting fairness audits and offering appeal channels and human review. And so, in short, the future of regulation needs to catch up with innovation. It's not just about fixing problems after they happen, it's about building systems that are fair and transparent from the start. And thank you, and I will pass to my peers.
Judy and Ing, those were wonderful points on how various organizations are trying to mitigate the inherent risk involved in the digital banking experience. I found it interesting that consumers in the US have the option of opting out instead of opting in for data sharing. And I'm sure some people here have thoughts on that, but we'll leave that for another time. Moving on, my colleague is going to present some common concerns being heard within board of director meetings. Go for it, Emily.
Thank you, Samuel. Hi, everyone. My name is Emily. And as we discuss the role of AI in digital banking, it is crucial to recognize that the technical transformation brings not only innovation, but also raises evolving concerns among boards and senior leadership. Some of the most common concerns include fraud, information leaks, and data privacy. Let's start with fraud, which generally falls into two categories: transaction fraud and identity fraud. Transaction fraud involves unauthorized or deceptive financial activity. It often targets online and mobile banking through methods like phishing, card fraud, or account takeovers. As digital banking becomes more popular, it's also becoming a bigger target for fraudsters. To fight this, cybersecurity systems use tools like encryption, two-factor authentication, and real-time fraud monitoring to protect users and their accounts. Next will be identity fraud. Fraudsters use stolen personal information to impersonate someone and access accounts or apply for credit. Nowadays, AI supports identity verification through facial recognition, document scanning, and behavior tracking. Tools like biometrics and digital ID checks play a growing role in fighting this kind of fraud. Another evolving concern is data sharing and information leaks. Consumers often share their personal and financial information with service providers. This opens the door to data leaks and unauthorized access. As our panelist Judy mentioned in the regulation section, banks are required to inform customers of their right to opt out of certain types of data sharing. Exercising these rights allowed users to limit how their information is shared with external partners or used for marketing purposes, which helped to reduce the risk of personal information leaks. Nowadays, as financial institutions use AI to offer personalized services, they have to rely on large amounts of user data. This raises questions about transparency and consent. Some platforms use methods like scroll wrap agreements, where users must scroll through terms and conditions before clicking agree. The goal is to encourage people to at least skim through the information before giving out their rights. But even with these measures, when personal data is accessed or used beyond what the user expects, it becomes a case of data misuse. Now let's take a closer look at one of the most common forms of fraud we might personally encounter: credit card fraud. As we can see from the diagram, projected global losses from credit card fraud are expected to reach $43 billion by 2026. The United States is a major target, accounting for a significant share of those losses. In fact, losses in the US alone are projected to exceed $12.5 billion by the end of 2025. One recent example comes from Wells Fargo's co-branded credit card with Built technology. It's a startup company with innovative idea that allowed customers to use it to pay rent while earning credit rewards. However, in 2022, before many customers even received their physical cards, fraudulent charges were already showing in their digital banking account. According to the company, this happened due to a bin attack, where fraudsters use bank identification number to generate and test card numbers until they found ones that worked. This case highlights not only a weakness in fraud prevention, but also the risk of scaling fintech partnership. Finally, let's talk about the key takeaways that the Wells Fargo case brought us. Wells Fargo is reportedly losing up to $10 million per month from this single co-branded card partnership, not just from fraudulent activity, but also due to poor forecasting of user behavior and business performance. As a result, Wells Fargo suggested that they may reconsider continuing the partnership beyond 2029 if there are no significant improvements. Learning from Wells Fargo's experience, this case offers us a lesson about the importance of thoroughly evaluating a partner's financial health, regulatory compliance, and internal controls before the partnership, not just the attractiveness of their business idea. At the same time, while companies increasingly rely on AI for fraud detection, this also introduces new risks, such as algorithmic bias and data privacy concerns. In the US, credit models are strictly regulated, and AI systems must not use protected characteristics like race, gender, religion, and similar factors when making decisions, especially when approving or rejecting credit. The Apple Card example that our panelist Yuning discussed earlier clearly illustrates what can happen when these regulations are not followed. All these cases reminded us, at the end of the day, strategic oversight must span across product development, technology compliance, and regulation. And that concludes my presentation on board-level concerns surrounding technological advancements in financial services. Thank you.
Awesome, Emily. I really appreciated those insights and the case that you provided. The case with Bill is a great illustration of the overall trend that we're seeing today, which is that as technology becomes more sophisticated, so do opportunities for fraud. At the end of the day, and to use some accounting jargon, boards are focused on reducing the risk of material misstatements, and as a preventative measure, the occurrence of control deficiencies. So taking us deeper into this topic, Raymond will be talking about the different internal control procedures that companies could implement to help face these challenges.
Hi everyone, I'm Raymond Urbina, and today I'll be looking at how internal controls have evolved alongside the digital transformation of banking. Before the digital era, internal controls were entirely manual and relied heavily on people. Banks depended on in-person approvals, paper-based reconciliations, and periodic audits to maintain accuracy and ensure compliance. These controls worked for in-branch operations, but they were slow, prone to human error, and often inefficient. As digitization began, banks started introducing basic digital tools to support existing control processes. Online banking systems changed the game. Controls had to adapt, and become more automated. Software began to take over tasks like transaction logging and basic reconciliations, and rule-based checks started flagging unusual activity. This improved efficiency, but also introduced new complexities as banks adjusted to digital workflows. Today, internal controls are built into digital systems. Banking apps now handle real-time transaction approvals, automated workflows manage compliance, and control mechanisms are embedded in code rather than managed by people. This shift has streamlined operations, but also introduced new risks. Digital systems must now account for increasing complex threats. Next, let's explore some of the key risks to internal controls in today's digital banking environment. Let's take a closer look at the risks facing internal controls in today's digital banking environment. One major concern is that automated control systems can fail silently when their logic isn't well designed. For example, AI-based approval tools might overlook errors in transactions, and vague or overly complex system rules can make it difficult for auditors to detect discrepancies, issues that in the past might have been caught through human oversight during manual checks. Another critical area is access control. Unmonitored APIs can bypass standard approval processes, poorly manage administrator privileges that can lead to unauthorized system changes, and third-party integrations often introduce security vulnerabilities. This marks a big shift from the days when face-to-face oversight and physical access restrictions played a central role in maintaining control. Data integrity and change management also introduce new risks. Software updates can unintentionally break internal logic, unlogged changes may conceal errors, and inconsistent data flows between systems can make it harder to spot issues. These challenges complicate the reliability once provided by manual processes like reconciliations and physical documentation reviews. As banks continue to depend more heavily on digital infrastructure, it's essential to understand how these changes are impacting real-world banking operations. So let's explore that next. Now that we have seen how internal controls have evolved from manual processes to fully embedded digital systems and discussed the risks introduced by that shift, let's take a clear look at the real-world challenges we're facing today. First, there's the issue of AI-driven decisions lacking transparency. Take the Apple credit card case from earlier. The system offered lower credit limits to women compared to men with similar financial profiles. Because the logic behind the decision was embedded in the AI, there was no clear explanation available. This highlights the growing challenge. When internal control logic is written into code, it becomes harder to audit, explain, or even detect when something is going wrong. That's a serious risk to both fairness and trust. Second, consider third-party risks, especially when it comes to fintech partnerships. In the Wells Fargo and Built Technologies example from earlier, customers were hit with fraudulent charges before they ever received their credit cards, caused by a BIN attack. This shows what happens when internal control systems don't adequately vet partners or monitor vulnerabilities in shared infrastructure. APIs and external integrations increase complexity and introduce new points of failure that many banks still aren't equipped to oversee. Finally, we can't ignore gaps in regulation and customer protection. Peer-to-peer apps and digital wallets like Venmo, PayPal, and Apple Wallet weren't always covered by traditional banking rules, and funds may not be FDIC insured unless swept into a partner bank. And with cryptocurrencies and stablecoins, there's often no regulatory clarity or guarantee protection at all. At the same time, these digital platforms collect huge volumes of user data to power AI-driven personalization, which raises concerns about data privacy, consent, and misuse. So even though digital transformation has brought incredible speed and convenience, the risks to internal controls are real and growing. These examples remind us that strong, explainable, and adaptable internal controls are more important than ever to protect the consumers, ensure compliance, and maintain the trust in the system.
Raymond, that was a great breakdown of the evolution of internal controls and modern applications to real-world challenges. Clearly, internal control procedures adapt with technological developments. And as an analogy, think about your home security system. A few years ago, a lock and key mechanism was probably enough to protect your house, but as the times have changed, families have upgraded to smart locks and cameras because why not? Well, companies are doing the exact same thing, and I'm going to hand the mic over to Ava to offer some recommendations on how to stay ahead of the game. You got it, Ava.
Thanks, Samuel. And hi, everyone. I'm Ava. The examples of AI-driven risks and third-party vulnerabilities really set the stage for the question we are all asking. What should leadership actually do all about this? The truth is, managing digital risk isn't just an IT function anymore. It's a board-level responsibility. And as Emily mentioned earlier, as fraud, identity theft, and information leaks increase, companies can't afford to wait and react. Leadership needs to be involved upfront. That starts with structure. We've seen big banks like JP Morgan from digital subcommittees within the board because someone needs to be focused on AI oversight, cybersecurity gaps, and fintech partnership risks. But structure alone isn't enough. Boards need real-time visibility. If there's an AI error in credit scoring, or a branch like the one Raymond described with Wells Fargo's API vulnerability, that information should be hitting the boardroom right away, not buried in a quarterly memo. That's where regular briefings from CISOs and CIOs become essential. And to know whether they are doing enough, boards need perspective, benchmarking their digital maturity against peers like Citi and Wells. Just like how Yuning described different regulatory gaps around stablecoins, digital governance also needs a framework to comparison. because without it, it's hard to know where your blind spots are. Then comes education. Judy did a great job explaining how quickly compliance standards are shifting from SAB 121 to SAB 122, and how SOX now includes AI-based systems. But if your board members don't understand what those systems are, how can they provide effective oversight? Beyond the boardroom, leadership also needs to shape culture. As Yuning pointed out, consumer platforms are collecting more personal data than ever. And that requires everyone, not just compliance teams, to understand the risks. A digital-first, risk-aware mindset needs to be embedded across the org. And the people making those decisions at the top, they need to have the right experience. As Emily discussed with the Apple Card bias case, algorithmic decisions can go wrong. And when they do, someone has to be able to question the model. That's why boards are under increasing pressure to bring in directors with real tech governance experience. So once leadership is engaged, how do we formalize those responsibilities? First, by setting clear AI usage policies. If you are using machine learning to approve loans, you need to know how this system works and who's responsible when it doesn't. These systems also need to be auditable. Like Judy explained, the SEC expects transparency in systems like blockchain and tokenization. That means documentation, decision logs, and explainable outputs, not just the results. These systems are too complex for any one team to manage. So banks need to form cross-functional governance teams that bring together IT, legal, and compliance, and speak the same language when it comes to risk. We also need to rethink internal controls. As Raymond showed us, traditional SOX frameworks don't cut it anymore. AI lending platforms, real-time approvals, they all need to be put into updated compliance structures. And it's not just about what the system does, but who interacts with it. Strong access controls and audit logs help companies catch issues early before they escalate into regulatory problems or reputational damage. Lastly, every company should have a clear escalation plan. If an AI model denies a monitored application unfairly, or a smart contract misfires, there needs to be a roadmap, not just for fixing the tag, but for protecting customers and communicating with regulators. So in short, digital finance has outpaced traditional governance. Now it's time for leadership to close that gap, not just by understanding the risks, but by putting in the structures to manage them. And this is my part. Thanks for listening.
Thank you so much, Ava. And now we've reached the bottom line. And there are 3 important points that I want to express. Number 1, and similar to what I was talking about at the beginning of the presentation, financial services don't just apply to traditional banks anymore. And the line between traditional banks and regular companies is blurring when it comes to financial services. Number 2, staying up to date has never been more important. Judy, Ning, and Raymond discussed different regulations and compliance procedures related to digital banking and showed how organizations are adapting to rapid developments within the industry. Therefore, companies must find ways to stay informed with what's going on. And one way that I know companies are doing that is by attending information sessions and webinars like this one, and taking a proactive approach to stay in the conversation. And number 3, expect the expected when it comes to the evolution of digital banking. To my colleague Dylan's point, technologies like AI and blockchain are here today and are only going to become more prominent as the days go by. Notice, I didn't say years, but days. And therefore, companies should welcome them, but stay wary of their potential. And to quote the great Warren Buffett, and I love this quote, "It takes 20 years to build a reputation and only 5 minutes to ruin it." That perfectly sums up the stakes that we're dealing with here. The hard-earned benefits of digitization and data sharing can be quickly undermined by a single lapse in internal control or a failure to safeguard data. So let's work together and build responsibly on what we already have going on. Again, thank you all for coming out, and I hope you've enjoyed our presentation.
Wonderful. Thank you so much, Samuel and team. That was great. That was very insightful. Really, really insightful to hear some of the key challenges of traditional and established financial service players and how the role of digital banking regulation will impact the future of financial services. So thank you so much for all your insights. For those who joined the conversation and are eager to hear what have been discussed, the full replay will be posted on the Ready YouTube channel. And if you would like to get a presentation summary or the slides, feel free to contact our Capstone team directly. We appreciate your time and expertise, team, and thank you so much for contributing to the 2025 MPAc Capstone Conference. So again, thank you so much for the insights, and thank you everyone that participated to the conference. Thanks all, and have a wonderful evening.